Most people woke up today thinking they were early. They saw the headlines, saw the charts lighting up, and felt that familiar knot in the stomach that whispers, "If I don't buy now, I'll miss it." By lunchtime, that same feeling had flipped into confusion. By the afternoon, regret. That emotional whiplash is not an accident. It's how markets teach their most expensive lessons. Let's rewind. Over the past 24 hours, silver became the center of attention after a major Wall Street research note made the rounds. A large, respected bank published a bullish outlook that immediately spread across financial media, social feeds, newsletters, and trading desks. The number itself almost didn't matter. What mattered was the signal. Big bank, big forecast, big excitement. Retail traders did what retail traders always do when authority validates a bullish narrative. They rushed in. By early Wednesday, buy orders stacked up fast. Momentum traders piled on. Breakout chasers chased. The price surged, slicing upward until silver briefly printed above $82, flirting with levels that had already proven dangerous in recent weeks. To the untrained eye, it looked like confirmation. To experienced players, it looked like something else entirely. An exit door being quietly opened. And then, right on cue, the air came out. Not gently, not slowly. It snapped. Selling hit the tape hard. The price didn't stall. It dropped. Within hours, silver was trading closer to 78 hustlers, wiping out the entire morning's excitement and then some. Anyone who bought the spike wasn't early. They were liquidity. This wasn't chaos. It was choreography. Markets don't move on headlines alone. They move on positioning. When a price is already extended and a widely circulated bullish report hits the wires, that combination often creates the perfect environment for distribution. The institutions that accumulated much lower finally have what they need. Enough eager buyers to absorb massive sell orders without collapsing the market instantly. So they sell into strength, into optimism, into certainty. This is the classic sell the news setup. The narrative sounds bullish. The action is anything but. If you're wondering why the drop felt so violent, it's because silver is a high beta asset. It exaggerates emotion. On the way up, it feels unstoppable. On the way down, it feels personal. A 3% daily move is nothing unusual for silver, but when it happens, right after a euphoric spike, it feels like betrayal. In reality, it's just gravity reasserting itself. From a technical perspective, the damage was predictable. Silver didn't break into new territory. It failed at a familiar ceiling. Just days earlier, the market had rejected prices near the same zone, leaving behind a memory. Traders remember where they lost money. So do algorithms. When price returns to that level and fails again, it forms a pattern technicians know all too well. Two peaks, roughly equal highs, followed by rejection. The infamous double top. That pattern doesn't mean silver is dead. It means the market is not ready yet. It signals that sellers are active, defending that area aggressively. Until price can break and hold above it with conviction, every rally into that zone is suspect. Breakouts aren't about touching a number. They're about acceptance above it. That didn't happen today. Zoom out slightly and the picture becomes even clearer when you look at gold. Gold didn't collapse. It softened. A modest pullback, well within normal consolidation behavior. That matters. Gold is the anchor in the precious metals complex. Silver is the lever. When gold sneezes, silver catches a cold. When gold shrugs, silver overreacts. That's exactly what we saw. The broader metal space experienced pressure, likely tied to modest moves in yields, but nothing resembling panic. Silver simply amplified the move. This tells us something important. Today, a sell-off was more about positioning and emotion than about fundamentals. Silver ran too far, too fast on a headline. When the fuel ran out, gravity took over. Now let's talk about the number that set all of this in motion. Big price targets have power, but they also create confusion. When a major bank publishes a long-term projection, they're speaking in years, not hours. They're modeling supply constraints, demand curves, industrial consumption, and macro trends that unfold over time. But the average trader reads the headline and compresses that timeline into days. That mismatch is where losses happen. A long-term bullish thesis does not guarantee a straight line up. In fact, the strongest secular bull markets are often the most violent in both directions. They shake people out, they punish impatience, they reward alignment between strategy and time horizon. If you believe silver's long-term case is strong, a $2 daily drop is noise. If you're leveraged, chasing momentum on a 1-minute chart, it's catastrophic. Same market, completely different outcomes. The difference isn't intelligence, it's time frame. Here's where things get interesting. While today's price action was ugly, the broader signal beneath it is hard to ignore. A major institution that spent years dismissing precious metals is now openly acknowledging structural issues in the silver market. That shift matters far more than an intraday spike and drop. Institutional narratives change slowly, then all at once. When a bank with a long history of skepticism starts talking about supply constraints, inelastic mining output, and rising industrial demand, that's not noise. That's positioning. It suggests that the conversation inside boardrooms and investment committees is evolving. This doesn't mean they're suddenly altruistic or trying to help retail investors get rich. Banks don't work that way. But it does suggest they're preparing clients for a different regime. And when institutions change their language, capital follows, eventually. It's also important to understand how these reports function in the real world. They're not trading signals. They're permission slips. Large pools of capital, pensions, endowments, sovereign funds, don't move into assets without institutional cover. A bullish research note provides that cover. It legitimizes an allocation. It opens the door. The money doesn't rush in overnight. It trickles, then flows. That's why today can be both a trap and a tell. The pump may have been opportunistic. The pivot is real. So where does that leave silver right now? In a range. Frustrating, volatile, emotionally exhausting. The upper boundary has been clearly defined. The lower boundary is still being negotiated. This is the part of the market cycle where patience is tested and discipline matters most. Silver hasn't invalidated its longer-term thesis. It hasn't broken down structurally. What it has done is remind everyone that headlines are not signals, and excitement is not confirmation. The market punished late entries and rewarded restraint. If there's a takeaway from today, it's this. Understand who a headline is for. Understand the time horizon behind a forecast. And never confuse a story with a setup. Markets don't move to make you money. They move to find liquidity. Today, liquidity was found at the highs. The road ahead will not be smooth. If silver truly is entering a new phase driven by real supply constraints and rising industrial demand, the path will be messy. There will be shakeouts. There will be false starts. There will be days like today that feel irrational and unfair. That's the cost of admission. The destination may be compelling, but the journey is designed to test conviction, not comfort. And if nothing else, today offered a valuable reminder. The loudest headlines usually arrive right when the market needs them most. Not to inform you, but to use you. At some point, even the most stubborn skeptics have to look at the numbers and admit reality has changed. That moment arrived quietly, buried inside a research note most people skimmed for the headline and ignored the substance. But the substance is where the real story lives. For years, the argument against silver followed the same tired script. Prices go up, miners respond, supply increases, and the shortage disappears. Problem solved. That narrative just collapsed under its own weight. The admission was blunt. Even if prices rise sharply, mine supply is not coming to the rescue. Not this year, not next year, possibly not for several years. Projects take too long, capital is constrained, grades are declining, and permitting is a nightmare. Higher prices don't flip a magic switch. The shortage isn't cyclical, it's structural. That alone kills the bear case that price will fix everything. Then came the second concession, and this one cuts even deeper. For a decade, analysts insisted solar demand would become more efficient, that engineers would thrift silver out of panels, replace it with cheaper materials, and cap long-term demand. It sounded reasonable. It was also wrong. The report effectively waved the white flag on that theory. Solar demand isn't slowing, it's accelerating. And silver isn't being engineered out fast enough to matter. The green transition is consuming silver faster than it can be replaced, let alone mined. The demand curve is climbing while supply is flatlining. That's not a temporary imbalance. That's a collision. The third admission is the one that quietly changes everything. Silver was no longer framed as just an industrial input. It was explicitly linked back to gold, not as a sidekick, not as a byproduct, but as a monetary metal that must reprice when gold breaks out. When gold moves into new territory, silver has to follow or the ratio snaps back violently. That's not a fringe argument anymore. That's institutional language acknowledging silver's monetary premium. In plain terms, they admitted silver is money. When a bank that spent years leaning against this market finally concedes all 3 points at once, it's not analysis anymore. It's capitulation. It is the financial equivalent of a general admitting the battle is lost and handing over the sword. The math won. The narrative caught up. So why does any of this matter when the price just fell hard? Because the people who actually move markets don't trade off panic candles and YouTube thumbnails. They trade off credibility. Pension funds, endowments, sovereign pools of capital don't chase momentum. They wait for institutional validation. They need cover, not emotional cover, reputational cover. Imagine you're managing retirement money for teachers or firefighters. You believe silver is undervalued, but you also know what happens if it drops 10% and someone asks why you bought it. You don't want to explain a Twitter thread. You want to point to a research note from a major bank and say, this is why. That piece of paper matters more than any chart on a single day. That's what this report provides. It removes the career risk of owning silver. It tells the conservative side of the market that buying this asset is no longer fringe behavior. It's sanctioned. It's defensible. And while day traders were dumping positions on a headline fade, allocators were reading footnotes, forwarding PDFs, and lining up committee discussions. That process doesn't show up on an hourly chart, but it's how real money moves. Big ships don't turn on a dime, but the wheel just moved. Now comes the uncomfortable question: why publish this now? If a bank were still heavily short, logic says they'd want to talk prices down, not normalize extreme upside targets. The only explanation that makes sense is positioning. You don't have to publicly float explosive price targets unless you are already on the right side of the trade. The simplest answer is often the correct one. The short exposure is gone. It's entirely plausible that during the volatility and illiquid conditions of late December, large players used the chaos to unwind positions that had become untenable. Once the risk was neutralized, the incentive flipped, from suppressing price to promoting upside. That's not conspiracy, that's Wall Street. First you buy quietly, then you change the narrative. Later you sell into the enthusiasm you helped create. This also explains the intensity of the early January rally. It wasn't just retail chasing candles, it was institutions repositioning ahead of their own research becoming public. Front-running your own note is not illegal. It's standard operating procedure. Cynical? Absolutely. Bullish? Even more so. You want banks involved in a bull market? You just don't want to be late. And when a large bank drops a number like $300 into the public conversation, it stretches what people consider possible. The Overton window shifts. Yesterday, that number sounded absurd. Today, it's debatable. Tomorrow, it becomes an anchor. That psychological shift matters more than most realize. Once the public accepts that extreme outcomes are plausible, behavior changes. $80 no longer feels expensive. It feels early. Traders hold longer. Refiners delay selling. Miners hedge less aggressively. The belief in higher prices creates the conditions that push prices higher. It's reflexive. Narrative drives behavior. Behavior drives price. Price validates narrative. So, yes, the price dropped today. Mechanically, that makes sense. But the value of the story just multiplied. An idea was planted, and ideas don't show up on charts. They show up later in positioning reports and allocation flows. Still, markets don't move on stories alone, and charts don't care who wrote the research note. Price is price. And the price action today was ugly. There's no way around it. A large red candle. A failure above $80. A structure that, at first glance, looks ominously like a double top. If you're a technical trader, this is the part where your stomach tightens. 2 rejections near the same level in a short time frame is not something you ignore. It suggests supply is heavy above that zone. It suggests buyers ran out of momentum. And in a textbook world, it points to a deeper retracement. That's why fear spiked. On paper, the pattern targets much lower levels. People see that projection and imagine a waterfall. Social feeds light up with calls for $70, sometimes lower. That's the bear case, and it deserves respect. But context matters. In markets driven by inflation, shortages, and structural demand, classic patterns often morph. What looks like a top becomes a handle. Instead of collapsing, price goes sideways. It churns. It frustrates both sides. Sellers unload into bids that don't flinch. Buyers absorb supply without chasing. Look closely at how price behaved after the drop. It didn't accelerate lower. It stuck. Every dip into the high 78s found support. That's not panic selling. That's profit-taking meeting patient demand. High volume with limited downside follow-through is not distribution. It's rotation. Weak hands exit. Strong hands step in. This is how accumulation actually looks. It's boring. It's uncomfortable. It feels wrong because it doesn't reward impulsive behavior. Institutions don't chase green candles. They wait for red ones. The immediate battleground is clear. The high 70s matter. That zone was resistance before the breakout. Old ceilings often become floors. If price can hold here, the broader trend remains intact. Below that sits a more important level around $75. That number isn't arbitrary. It was the lid on the market for weeks. Everyone sees it. Everyone has orders there. If price revisits that area and holds, it reinforces the idea that the breakout is being retested, not reversed. If it breaks cleanly and fails to recover, then the narrative pauses and the market has more work to do. That's the line in the sand. For now, the trend is bruised, not broken. Short-term charts look damaged. Long-term structure remains powerful. This is where discipline beats excitement. The story didn't end today. It just got louder, messier, and more interesting. And as uncomfortable as it feels in the moment, this is exactly what the early stages of something much larger tend to look like. Here's the part nobody wants to hear when the screen turns red. This move is uncomfortable, but it's not automatically catastrophic. A pullback only becomes a failed move when it breaks the levels that matter. And right now, we're still sitting a few dollars above the real danger zone. That buffer is the difference between a normal shakeout and an actual trend change. A 3% drop feels like a punch to the face, sure. But if you're still up 20% from the last major base, that's not a knockout. That's the market reminding you it's alive. Let's talk about why this drop happened and why, oddly enough, it may have been necessary. Yesterday, momentum was running hot. The daily RSI was pushing into the high 70s, flirting with that overbought territory where trends start wobbling. When RSI climbs that high, it's like an engine redlining. You can do it for a short burst, but if you keep your foot down, something breaks. Today, S-flush did what a flush often does. It cooled the system down without destroying the structure. RSI slipping back into the 60s isn't bearish, it's healthy. It's the market taking a drink of water, wiping its face and saying, okay, now we can keep going. Nobody runs a marathon at sprint speed unless their plan is to meet the paramedics at mile 3. And here, I'll mix the uncomfortable truth. If silver had continued straight up from $80 to $83 to $86 without breathing, the odds of a much uglier crash later this week would have been higher. The market would have created a blow-off move, fast, dramatic, and fragile. Instead, we got the boring version, consolidation. It's the vegetables of a bull market. Nobody wants it, but it's how you stay alive long enough to enjoy dessert. Now check gold, because gold tells you whether silver is sick or just being dramatic. Gold being down around $32 to roughly $453 is not a collapse. It is a paper cut. Gold is still near its highs, still in an uptrend, still acting like the steady adult in the room. Silver, meanwhile, is the emotional teenager slamming doors because someone looked at them funny. That relationship matters. Silver can't sustain a true bear market while gold is holding a bull structure. It doesn't mean silver can T-drop. Of course it can. But it does mean the bigger trend is harder to break. Also, when the gold to silver ratio widens slightly, it makes silver cheaper relative to gold, which is exactly what value buyers and ratio traders look for. Those algorithms don't care about the drama. They care about spreads. When the ratio stretches, they step in to compress it. That's why gold acts as the anchor. It prevents silver from drifting into open ocean. Now, let's preempt the headlines you're going to see next. Silver crashes. Bubble bursts. Investors flee commodities. The media loves a crash because fear sells better than nuance. They'd all zoom in on one red candle and ignore the bigger context, like silver being massively up recently, or gold still holding strong, or the fact that this move had the fingerprints of a classic sell the news flush. They report the price, not the mechanics. You understand the mechanics. That's your edge. So what do you do now? Here's the part that separates professionals from people who donate money to the market in exchange for stress. You stop making decisions off intraday emotions, and you start watching the close. Not the hourly close, the weekly close. In professional trading, amateurs obsess over the open, professionals obsess over the close. Intraday moves are warfare, noise, and bait. The trend is determined by where the market settles when the week ends. And this week, the whole game comes down to one level, $75. We have the rest of Thursday and Friday to watch how price behaves around that area. If silver closes the week above $75, the weekly candle likely shows a long wick, meaning we got shaken. But it also shows a body that respects support. That tells the market, yes, volatility is high, but the breakout holds. Algorithms don't panic at wicks, they panic at failed closes. A weekly close above $75 is the bull's pass mark. But if bears manage to push silver below 75's fars and keep it there into Friday, yes, close, that's when you start talking about a deeper correction. Not because the story changed, but because the chart printed a failure. A failed breakout on the weekly chart invites follow-through selling, and it can drag prices lower before the next base forms. So keep your eyes on that line. It's not emotional, it's structural. Now, let's address the elephant in the room, the Bank of America target. You're looking at $78 and thinking, that upside forecast feels like a meme right now. That's normal. But the mistake is confusing timing with destination. A long-term target doesn't mean tomorrow. It means this cycle. And the real question you should ask is, did anything fundamental change today? Did solar demand suddenly stop? Did industrial consumption vanish? Did mines magically discover a decade's worth of new supply? Did debt levels reverse and central banks stop playing the same game they've played for years? No, none of that changed. Today was a sentiment event.